This module is all about equity, specifically shareholders equity. And equity is one of the trickier topics to teach and to learn. And the reason is, I think when we've looked at financial statements, journal entries, T accounts, those types of things, those are fundamental building block concepts in accounting. We also looked at assets and liabilities. And in my mind, most people kind of have an innate understanding of assets and liabilities. If I say, oh, the company bought a car or the company bought a building, you can imagine a company buying a car or a company buying a building. Or in the liability side, the company took out a mortgage or issued a bond, which is a more complex topic. One can kind of imagine what's happening. With equity, I think it's just harder to sort of synthesize, because I just think that the equity transactions are not ones that just immediately come to mind for somebody. So to understand equity, you need to understand the terminology surrounding equity, and I'm going to introduce or reintroduce a few of the terms in this intro video, and then we'll look at some journal entries and just disclosure issues surrounding equity. I don't think I go as deep here as I do in other topics. Equity is a topic that, depending on your prof, a lot of profs like to leave the heavy lifting of equity for intermediate accounting classes. This is an intro video set, so this may be a little too introductory if you're looking at intermediate accounting, but certainly for intro people, you are in the right place. So let's talk a bit about equity. And the first thing I want to touch on when it comes to equity, the first term I want to discuss is common shares. And at this point, we should all have a pretty decent understanding of what common shares are. They're the basic unit of equity. They're what we call invested capital. So somebody wants to invest in a company, they purchase common shares. And that's one way a company gets money, right? They sell common shares to investors. Investors pay the company money to get common shares. And common shares entitle the owner of the common shares to the rights and rewards of ownership. The common shareholders are the owners of a company. It doesn't guarantee any returns. So if a company goes down, well, your common share value is going to go down with it. If a company does really well, the common shares will do really well. It sort of gives you the rights and rewards and risks of ownership. So this is the basic unit of ownership. We've seen a lot of transactions involving common shares. We're assuming if you're an American, you might have a slightly different take on common shares. We're assuming no par value here. Common shares get issued for whatever the price is. And again, if that phrase par value isn't coming up in your textbook, that's not a huge surprise. It's a notion that's leaving us, but it does still exist in some American companies. So that's common shares in a nutshell. The other piece of invested capital I want to look at is preferred shares. And preferred shares are kind of interesting. I always thought when I was a beginning student, or when I was just learning about the stock market, even as a kid, I kind of was interested in the stock market. I always thought preferred shares, those are the good ones. Why? Because it's in the name. They're preferred, right? Wouldn't you prefer to have a preferred share? And the answer is not really. Preferred shares, what the preference talks about. Why are they preferred? They're preferred when it comes to dividends. Preferred shares typically will feature a guaranteed dividend, and preferred shares will get paid dividends first ahead of common shares. And the other thing they get preference for is if a company folds, like if a company goes bankrupt, what happens is people line up, the people that the company owes money to line up and they look for their money, right? And there's a lineup, and a bankruptcy trustee will have to sort of sort out, okay, who's first in line, who's second in line, who's third in line. Preferred shares get a better location in the line of people asking for money from a bankrupt company than common shares. Common shares are like last in line. They don't generally see much. So, but what preferred shares don't do is really participate with the common shares. If a company makes a lot of money one year, common share values typically go up. Preferred shares, they don't sort of rise and fall with company performance. They're a much more stable type of investment. Now, having said all of that, Some preferred shares can. Some preferred shares have features that allow them to convert into common shares, and many preferred shares are considered cumulative preferred shares, and that means their dividend is guaranteed. If the company misses their dividend one year, the company must pay the dividend the next year. So preferred shares are a more dividend-paying class of share, and they have dividend preferences, and that's why they're called preferred. They're much less usual than common shares. You see them less regularly than you do common shares. And there's all sorts of complex share structures that at like very high-end companies. I know Google has a pretty fancy one, and a lot of sort of high-end tech companies. Alibaba is another one with a very fancy share structure. But, we're looking at more of an introductory class here, and that's how I would think about common shares and preferred shares as I was learning about the topic. So what other types of equity? Well, we've been introduced not only to this, what I would call contributed capital, we've also been introduced to earned capital in the form of retained earnings. And when I think of retained earnings, I just really think of the words, and I try to understand the words. Retained means kept. Earnings in accounting means profits. So it's profits the company is keeping in the company. So again, if my company had retained earnings last year of $50K, we made profits of $100K, well, that adds $100K to my retained earnings. My retained earnings are now $150. However, I don't have to keep that money in the company. Maybe I'll pay a dividend of $20K, and so my dividends reduce my retained earnings, bringing them down to $130. So that's how I think about retained earnings. I just think it's the profits that I'm keeping. It's the profits that I'm not paying out in the form of dividends. There are times when retained earnings has to be adjusted and has to be altered, but if we're fixing an error from prior periods, that is a matter for intermediate accounting, in my view, not for intro. Okay, a couple of other accounts to worry about. Well, the key one I want to focus in on is accumulated other comprehensive income. Now, what is accumulated other comprehensive income? It's a mouthful, first of all. I'll abbreviate this as AOCI from now on. Accumulated other comprehensive income is sort of like revenues or expenses, revenues or costs that accounting rules have dictated do not belong on the income statement. So they have a lot of the features of revenues or expenses, but they don't belong on the income statement. So what could possibly fall into this classification? Well, here are the sort of guidelines. It has to be a gain or a loss that is thought of as transient. Now, what do I mean by transient? I mean here today, gone tomorrow. It's just coming, it's going to go. So it has to be transient. It has to be outside of the manager's control, or at least thought to be somewhat outside of the manager's control. So we're not trying to give credit or blame to the manager for having suffered this loss. And those are really two of the key features, right? It's transient, it's outside of the manager's control. And then there's categories. Now, I'm not going to go through the categories of other comprehensive income. I'm just going to give you one example. And the example I like to give here is a lot of losses and gains in foreign currency. So let's say I'm Nintendo, a Japanese company, and let's say they report everything in yen, and let's say the yen is weak. If the yen is weak, that's really good for Nintendo. Why is it good for Nintendo? Because they sell stuff in dollars, they sell stuff in euro, they sell stuff in the world's currency. They sell around the world. So if the yen is weak, and when they translate it back into yen, they're selling this stuff in dollars, they translate it back into yen, it looks really good on Nintendo. Now, would I give credit to Mr. Iwata, Nintendo's president, because they had these big foreign currency gains? No. I would say that it was outside of management control. And Is it expected to be transient? Well, yeah, I would expect the yen to kind of ebb and flow, some years up, some years down. So I would say this is transient. So a lot of foreign currency gains and losses get considered AOCI. There's a whole list of them. If you just Google AOCI, Accumulated Other Comprehensive Income, you can see a list, but that's one example, a common type of other comprehensive income. So this gets tracked in our equity, and it's something I think is a little bit above an intro topic, but I did want to just explain or give you a basis for understanding what it is. There can be other things like contributed surpluses, which are like gains and losses in buying and selling your own shares, and or involved in having shares issued at par value. But I don't really wish to touch on those topics in this video. So these are the fundamentals, and really these three and like these two far and away are the fundamental pieces of equity. But I would certainly expect you to have a decent understanding of what those terms mean as well. All right, that's it for this video. We'll move on and do some problems in equity.